Hi there, I'm Lindsay Biscaya. Every 2 weeks on Wednesday, we are diving deep into the world of options trading, exploring the fundamentals of puts and calls and how you can effectively incorporate them as an investing tool to maximize your returns and manage risk. You can call us toll free right now, 1-855-326-6266, or you can email us at knowyouroptions@bnnbloomberg.ca and we will answer your questions. So let's bring in Thom, CEO and portfolio manager of Moat Financial. Hi, great to have you back in studio.
Yeah, good to be here. Thanks.
Okay, so we're talking about the VIX options, VIX ETFs. So I guess if investors are looking to kind of hedge their risk, is this a good avenue? Like, what are the best ways to do that before we get into what exactly VIX are? Yeah,
so the VIX is obviously a measure of risk. It's a measure of the price of options on the S&P 500. And it's often looked at as being a bit of a fear gauge for, what people are, how fearful people are and how much they're willing to pay for insurance. That's what people look at when they're talking about the VIX.
Okay. Okay, so now we're talking about the world of options in Canada when it comes to volumes and activity. So tell me more.
Yeah, so volumes are up a lot. So on overall basis, on equity options, which is what we're talking about on this show pretty much every time, volumes are up 23% year over year, which is really big growth. I mean, if you look at it's been on a steady trend for a number of years, and this year is no exception.
So where is this volume coming from then? If we're talking about like retail investors, institutional investors, what side, what percentage, I guess?
Yeah, so it's both.
Okay.
You're seeing retail growth as well as institutional, but a lot of it is coming from ETFs, which I guess is driven by the retail investor who wants access to these strategies. So they are buying them, and that's driving a huge piece of the growth. So people are, want these products, they want access to the strategies, but they don't want to actually do it themselves. So you've got different companies coming up with a slew of different products that can hit the market and drive up volumes.
Is that a new trend that we're seeing in terms of all these new products that are coming to the market?
So ETFs have been around for 25 years or so. Canada was actually a leader and had the first ETF out there. People got to tune into the show. You learn exciting things. But basically, at first, it was really a race to the bottom in fees. So you were looking at a lot of index-related options where people were looking for a cheaper alternative to higher-priced mutual funds. So a lot of those were index-related, and now you can get an S&P 500 ETF that has an MER of like 2 basis points. So the race is over. VOO has won. You can't really make a differentiated product on an index, but you can do it with an actively managed ETF, and that's where we're seeing a lot of the growth on the ETF side. And then most of those are incorporating options.
So active ETFs on the rise is what you're saying?
Yeah, the last 12 months, about 60% of the ETFs that have hit the market are actively managed. So, part of that is I think companies can charge a higher fee because you're actually doing something. You're not just putting together a basket that already exists and that other people are already doing. But also you're able to show your strengths as a manager and pinpoint the strategies that people want access to. And, I mentioned covered calls because if you go back to 2021 as an example, they were kind of obscure. People looked at options. Hey, what are those? Covered calls. I don't get it. But the growth in that area has been just enormous. There's one ETF provider in Canada that had about 500 million in assets in 2021, and they're up to 16 billion, all doing covered call strategies. So all of that volume is coming into the market and driving this growth.
Because we talk about that a lot when it comes to ETFs in general, like the growth that we're seeing, right? They're just growing in popularity. More people are getting involved in ETFs. But when it comes to the option side of things too, you're seeing growth there.
Yeah, I mean, it makes sense. There's a lot of ways to invest. There's different managers. You can go with different strategies. Covered call ETFs and cash covered put ETFs, I mean, they are an active strategy. It takes a lot of work, right? There's a lot of ways people can save money. You can bake your own bread or change your own oil, but going and paying someone else to do that so you don't have to have that expertise or take the time to do it makes a lot of sense. And that's, I think, a huge driver of where there's been growth on that side of the ETF space.
Yeah, because do you think people are getting a better understanding of options and how to trade with them?
Absolutely. I mean, these things have been around for a while, they've got good track records. A lot of them have really exciting yields. And so people can see, hey, this works. I understand that strategy. And so then when something new comes along, it's maybe not quite as scary or, weird. It's something that, hey, well, look, these other option strategies work. So why wouldn't this?
And then for people who are just getting involved, as we talk about this growing popularity, like obviously watching the show is a good place to start in terms of getting tips.
I recommend everybody do that.
Right? But how else can people really start to get into that side of trading?
Yeah, I mean, all the online platforms are, their technology is getting better. Access to this is getting better. Liquidity is getting better. So, just following the same path that people have been on for a number of years will actually give them better access than it was a few years ago. But there's just so many online tools for education beyond just this show. But, we host a webinar every week, or we do things with the Montreal Exchange to promote options in Canada and all that. So it's there's a lot of resources out there, and, they should use this one for sure, but it doesn't have to just be this.
You mentioned the Montreal Exchange, and you consider yourself the perennial defender of the Montreal Exchange. First of all, why?
Well, I mean, I think, options sometimes have, less liquidity than stocks. I mean, people who have been trading stocks forever, they look at options and, there might be limited volume and, sometimes there's some wider spreads. And so people will look at those, maybe not always understanding what type of volume there is underlying those options and say, oh, options in Canada don't have enough liquidity. But I can attest, and again, I don't get paid by the Montreal Exchange, but that volumes are good. I mean, I've built an entire career on trading options and finding liquidity for clients who want access to these strategies. And then we're seeing it with the growth. Every year, when volumes go up, that means liquidity is going up. And that means that things are better than they were before. And you just can't dispute the growth.
And you say they're continuing to get better every year as well. Like even going forward, that's kind of the projection.
Yeah, I mean, that 23% overall growth, I mean, that means there's 23% more options being traded. Mm-hmm. And then just looking sort of under the hood there, that was the institutional and retail. The institutional ETF side, that does drive the majority of the volume. But retail investors, their option volume has actually gone up 47% year over year. So it's booming even at the retail level.
For sure. Okay, we're going to take a quick break right now. Thom, CEO, portfolio manager at Moat Financial, will be back in just a moment, and we'll be taking your emails and calls. You can call us toll free. This is the number on your screen, 1-855-326-6266. Or you can email us at knowyouroptions@bnnbloomberg.ca, and we will answer your questions on the other side of this break. Stay with us. Welcome back to Know Your Options. Thom here today. He's going to start taking your questions. And we've got a first one. This is an email question, so we'll go to the inbox. It's coming in from Nolan. And it says, I love the show, so please keep it up. What are you doing with Cameco right now? It has been on a wild ride. Is it a good time to sell puts? Cameco. What are your thoughts on that? Yeah,
so thanks for that question, Nolan. I mean, Cameco is a stock that we like, and you are correct. It has been on a wild ride. It was all the uranium stocks were up quite a bit yesterday, and then most of them are giving all of that or more back today. So, this is where selling a cash covered put gives you that downside protection. So I've recommended selling puts on the show a number of times at, I think, $120, $130, and $140. Currently in our ETF, we are short the 130 put. So, with the stock right now at $159, you can give yourself quite a bit of downside protection and sell a put.
Get your pen ready.
I was trying to I think I hit something on the screen that, oh no. Yeah, so I mean, if we can get a chart that maybe goes a little further and has some lower prices, you can look out to August right now and sell like a 130 cash covered put and collect about $4.75. Okay, so that is going to be generating, 3.5%, almost 4% on that option, but give you that $30 of downside protection. So even though the stock went up yesterday and is giving that back today, you're not in a losing position because you still have $30 of downside protection and you're generating big premium over a relatively short period of time. And so yes, I think selling puts on Cameco is a good idea.
Okay, we're going to go to the phone lines now. John is calling in from Markham with a question. Hi there. What's your question?
Hi, good afternoon to both of you. Thanks for taking my call. Chris, I was wondering if you're aware of an option overlay ETF on the Canadian side that not only does cash secured puts, but also does a long put or a put debit spread for protection. There's a number of them in the States. Dynamic Funds has a mutual fund that does this. Their ETF, which is DXQ, I think only does cash secured puts. There's nothing on the protection side. Just wondering if you know of anything that or anyone that does that. Thank you.
Okay, great question. Thanks for that.
Yeah. So
yeah. Go ahead.
Yeah, no, so with regards to, the first part of your question was mentioning a Canadian option for this. My understanding is, as far as put selling ETFs go as a primary strategy, including Dynamic, who I don't know the ins and outs between the difference between their mutual fund and the ETF, but as far as ETFs and funds that sell puts as a primary strategy, there is only one that actually sells puts on Canadian stocks, and that happens to be the Moat Active Premium Yield ETF, which I am here, so that was not me who called in to mention that. But otherwise, they're all U.S., and they're mostly focused on Mag 7 because that's where the easiest liquidity is. So really, there is not much in the way of that. But, I think that this is going to be the next leg in growth in the ETF space here. We saw that huge growth in the covered call side, and I would bet that the put selling is the next leg. So while I say that doesn't exist in this moment, where they're buying additional put protection below it, that could be coming in the near future.
Why has that not existed up until this point, really, in Canada? I mean, obviously there's one, but why is that? What does that tell you about the Canadian market or Canadian investors? Yeah,
I mean, it's not even just Canadian. It's the U.S. as well. I mean, Canada, we are really leaders in this space as far as coming up with innovative products. Mm-hmm. I think it's an education piece. So, we talked about the covered call side 5 years ago. It was kind of obscure. It was a small piece of the market. But as the market and people and advisors and retail investors get more educated on it, it really grew. So I think that the put selling piece, because you get that downside protection that you don't get on the covered call or long only, I think that is going to be the next big leg of growth that comes into the space.
Okay. We're going to go back to the inbox. We've got an email from Luay now, and it reads, I've been using cash secured put strategy for TLT ETF, and when assigned, start selling covered call to generate income plus the dividend. What are your thoughts on this trade? Okay, thank you for that question. So TLT ETF, what are your thoughts on that trading strategy, by the way?
So selling puts, taking delivery, and turning around and selling calls, that's a great strategy. That's what we do.
Okay.
TLT is not something that we typically trade that often. For those who don't know, it's a 20-year bond ETF in the U.S. So, a big piece of what makes up option pricing is volatility. And these bond ETFs are typically less volatile, so their option prices tend to be a bit lower. That being said, you see a spike in interest rates, and volatility can really enter into this name, and not in a good way. It's something where I typically would not want to have sort of a low premium that I'm collecting with the potential for a big drop if we see option or interest rates, long-term rates move higher.
Right.
But the strategy itself is a good one. I just might want to do it on a different name.
Got it. Okay, we got another email, this one coming in from Sunny, and it says, what does Chris think about BlackBerry? Seems like it's on an upswing right now, and I am holding some call options right now with a strike $3.50 that expires mid-next month. Specifically wondering if I should sell now or hang on to it and own the shares when the calls expire. Your thoughts would be appreciated on what may be the best option to take. Okay.
Yeah, so I guess that question more revolves around what's my opinion on BlackBerry, and I guess it's had a great run.
Yeah.
It's obviously a very different business than it was 10, 15 years ago when they were in the handset world. Now they've moved more to supplying software, et cetera, for cars. So I don't have too much of an opinion on the name. I think this would all just go to what Sunny's opinion is on the stock itself. If you hold those options to expiry. They are in the money, and you will be assigned on those. So you will take delivery of that stock at $3.50. This taking delivery of that stock could be a way to delay triggering a capital gain versus if you sell those options. I'm assuming he bought them for a lot less than they're worth today. So no matter what you do on this one, I think near term you can give yourself a little pat on the back for a pretty good trade there.
It's hard when you see a company like BlackBerry. It's just been skyrocketing the last couple of weeks, right? So you don't know by mid next month is what I think Sonny said was the expiry date. You just have no idea.
Yeah, I mean, if you go back a few years ago when the meme stocks were going wild and GameStop was shooting through the roof, BlackBerry was one of those, and it got up, to slightly higher prices than it's currently trading right now, and then it all disappeared until now. So I would suspect that there's probably a lot of people who bought around that time that have been hanging on to it until now and will be exiting. But I'm not a technical analyst,
of course.
so I can't say that for sure.
Okay, we've got another email question. This one coming in from Stuart, and it says, what is your opinion of Atkins Realis? If you held this, would you use an option strategy? If so, what option call strategy would you be using?
So I don't hold this. I'm not a real expert on the name. It's definitely been a bit of a tough go here. It's showing it's down 11% over the last year, but year to date, it's just hit its new low for the year. So with that, if you are holding this stock and you're thinking, hey, I would like to try to have a bit of recovery on my position, you could start by selling a covered call. The option premiums are quite expensive on this. So even with the stock at 80.65, you can go out to August and sell a $90 call for about $225. So you're looking at just under 3%, but giving yourself $10 of upside between now and where you would get called away. So that would be at a level that the stock would be flat year over year. There are a few other things you might be able to do on the stock recovery side of things. And one would be a 1x2 call spread. So with that, you buy the 84 call out to August and then sell 2 of the 90 calls against it to pay for it. So that would be a slight credit that you would generate on that trade. And then you're making 2-to-1 between 84 and 90. So if the stock goes through 90, you have a net exit at 96, and you probably feel a lot better than you do right now. But you do need the stock to move higher. So we typically would look at just selling the covered call. These are expensive options, and that's the kind of stuff that you do want to sell.
Got it. Okay, another email. This one coming in from Thomas, and it says, hello, I am following your Moat ETF, but notice it has very low volume per day. Is there a reason why? Also, is the 20 cents going to be paid monthly per unit, thus yielding $2.40 a year? Okay, we'll start with the first part of that question. So low volume per day. Would you agree with that analysis?
Yes, much like I want everyone to watch the show, I also want everyone to buy that ETF. The volumes are low. It's a fairly new ETF, just came out in January. One thing that's important to understand is that volume and liquidity are not the same on an ETF as they are for a stock. So if you buy a stock, you're buying it from someone else in the market. So they have to have it in order to sell it to you. Whereas liquidity on an ETF, if you wanted to put in an order for $1 million worth of that ETF, and it exceeded the average daily volume by quite a bit, the market maker is there to sell you shares that they then create. This is how all ETFs get liquidity and how they grow. So you go buy XIU or SPY or one of these larger market-based ETFs, a market maker is likely selling you that stock if there's a lot of, or selling you those units if there's more buyers than sellers on that day. So volumes have been low, but liquidity is based on the underlying, and the underlying in that is very liquid. So do not fear not getting filled if you wanted to buy some.
Okay.
And then if you want me to get the second part about the 20 cents, we've been paying 20 cents a month for the last 5 months, and we plan to continue that going forward.
Okay. All right, we're going to take a quick break right now. Coming up, though, we'll get Chris Thom's top options trading ideas right after this. Stay with us. Okay, it's time now for Chris Thom's top options trading ideas. We're going to start with Costco. You say that this is your favorite retailer for sure when it comes to the retail space. Costco, why is that? And we're talking about the U.S. side to start.
Yeah, so Costco, obviously, it's a great business that has done nothing but deliver high quality experience for customers and good value in the store, and then it's been great for investors the whole way through. It does trade at a slightly higher multiple than a lot of the other retailers out there, which we don't love that piece of it, but we think that the quality is the reason.
And your suggestion here is to sell the July $925 cash covered put for about $15. Sorry, I forgot to mention that part.
Yeah, no worries.
The most important part.
So this one here, I did have to adjust this a couple of times because it's been pretty strong today. But this is, the stock's trading around 960. We're looking at selling the July 925 put for about $15. Now, that gives us $35 of downside protection. If we get assigned that stock, it's about $910, which is about the same price that the stock was trading at 2 years ago. So we're creating a situation where our worst case scenario is that we get long the stock at 2024 prices, which we think is great value because the business and earnings and everything is up about 20% in that time. So if the stock stays above the 925 level, which we've done this trade a number of times on the show, then we make $15 over 44 days and drive on and likely do it again.
And you've got basically the same trade, but on the Canadian version. That's your second pick.
Yeah, so same idea. I recommended this on the show one time, and a guy called me and said, hey, if you sell a put on Costco, that's 100 shares. So that's $91,000 or $92,500 US that I have to allocate to that. Not everyone's got that much money. Well, CIBC has been a big leader in Canada for launching these CDRs, the Canadian Depository Receipts, where they basically buy the stock, they chop it up into little pieces and sell it to you in a Canadian version. So that stock trades around $43. And so you can get the same exposure, same everything by selling the 4150 put out to July. So same expiry, same downside protection, and basically the same premium generated. And again, your worst case scenario is you're buying that stock at the same price that it was a couple of years ago, which we think is a great idea.
And lastly, you've got JP Morgan. So selling July for a $285 cash covered put for about $5.50. That's what you're suggesting here. Tell us more.
Yeah, so JP Morgan, we typically like to focus on the Canadian banks because we think that they are good value. Well, JP Morgan is also good value here. It's on a PE multiple basis. It's trading cheaper than all of the Canadian banks, and it's got a fairly good track record of success. We like Jamie Dimon as a leader. He's 70 years old, but he said, I'm not going to retire for quite some time, so we feel like we've got him at the wheel for the foreseeable future. He owns a ton of stock, so he's got skin in the game, which is another thing that we like. And then here we've got $15 of downside protection, or $16.50 of downside protection before we would hit that strike. And we're generating just about 2% over a month and a half. And that's a really great return. If you annualize that throughout the year, you're looking at north of 15%, and that's pretty good.
Pretty good. Okay, we're going to leave it there. That wraps up this edition of Know Your Options. Thom will be back in 2 weeks on the show as well. Thanks so much for coming in. Always fun.
Yes.
Great to have you.
Thank you.
And stay with us. We've got the close coming up next.